Welcome back. In this section, we will be looking at options moneyness. At the money, out the money, and in the money. In our previous examples, when we looked at calls and puts on Apple stock, we were using strike prices that were equal to the current stock price, which was around $150. These are called at the money strikes. When the strike is the same or very close to the current price of an asset, we call the options at the money. At the money options are traded in large volume, particularly by volatility traders. And we will learn more about volatility trading later in the course. But these are not the only strikes that you can trade. You can trade a whole host of different strikes. And those strikes can be above the current market price, in which case they are called upside strikes, or they can be below, in which case they are referred to as downside strikes. Now, whether or not you trade a call or a put on the upside or the downside will determine if it is considered out the money or in the money. What do we mean by this? Well, for an out the money OTM strike option, that is one where the strike is away from the current market price, such that the option would not be exercised if it was expiring today. So in the case of the Apple example, if the stock was trading at 150 and we had a call option struck at 160, that is the right to buy the stock at 160, then we would not exercise that right. Hence, that option is considered out the money. On the other hand, if we had a put option that was struck at 160, then you can see that anywhere below 160, the option is in the money because we would exercise our right to sell. So that is considered in the money because we are sitting on that diagonal part of the hockey stick where you would exercise your option and you would sell the stock at 160. So you can see upside strikes, calls are out of the money options, puts are in the money options. On the downside, it's the same story. So if we say again, the stock's trading at 150, but this time we look at a 140 strike put and the stock's here at 150, well, that is not an option that we would exercise on the day of expiry with the stock there, because it's the right to sell. It's the right to sell at 140, where the stock is currently at 150. So the out of the money option on the downside is the put option. If again, we look at a call option with the same strike, well, the 140 call is going to look like this, 140, and with the stock at 150, we are well and truly in the money. We are above the strike and we would exercise our right to buy the stock at 140. So as you can see, the in the money option on the downside will be the call option. So downside puts are out of the money, downside calls are in the money. And we can think about that hockey stick payoff. If we always go back to that payoff for calls and puts, if we are on the zero line, if we are on the flat zero line, then that means the option is out the money. If we are, however, on the 45-degree payoff, then the option is in the money. So that's the basic strike terminology that we use in options. Upside and downside strikes, and options, once you go through the strike, become in the money. If you are equal to the current spot, if the strike and the spot are the same, they are at the money. And if the options are out of the money such that they would not be exercised, they are the low premium out of the money options. Great. Next, we're going to look at options maturity.